Hello everyone and welcome to today's crypto major markets update for May 11th, 2022. More mayhem on the markets. Let's have a look. It appears we are in a extended fifth wave. Extended fifth waves can always happen. We had quite a normal third wave, a normal fourth wave, and it seems like this fifth wave wants to extend. That is, at least for now, the assessment that I can see. So let's have a look and go straight to the charts. We'll also review some other people's work as well as Market Breadth, which is close to a breaking point, let's put it like that, or important lows maybe. So here we have the NASDAQ100. Remember, I was tracking a impulse lower, a subdividing impulse with a wave 15 at Monday's low, a wave 16 at yesterday's high because that was an update, and now in wave 17. Can still not know if it's going to subdivide to 21 if it wants to. For now, the trend remains lower. We already knew way back here, once we got the overlap with the early March, late February high, that we would be looking lower. So far, so good. This is still underway. I have no signs of a reversal in place. As I said in Tuesday's update, that will require a break back above Tuesday's high. If we get back above Tuesday's high, we can move our goalposts a little bit further north. If we then break above last Wednesday's high, the Federal Reserve's high, that is sign number 2. And ultimately, we need still to break above the March highs. This looks miles away. It is quite far away, but the first order is to break above yesterday's high, which we failed to do today. The Dow Jones continues to extend lower as well. I'll show you the S&P 500 micro count where it appears to be wrapping up these smaller fourth and fifth waves. So we still have a nice symmetry, a B, and a C potential underway. Also here we see this very extended fifth wave. We bottomed a little bit south of where the third wave should top or bottom. We topped exactly where the fourth wave should top, and then the fifth wave should ideally bottom here, but again, the market doesn't owe us anything. It doesn't have to. And we are looking lower, which fits better with the symmetry target. So we have an extended fifth wave on our hands. I'll take this retrace back or off the chart because we've done a 62% retrace, and we should now be looking for this wave to complete. Again, it will require first and foremost a break above here. That is the first warning for the bears. And then we need to break above here, which is the second warning for the bears. And the bulls, in my humble opinion, will have the all clear sign once we break above here, because then we start to finally make higher highs. It is still definitely ways to go. And I see no letting up just yet to the downside. And extended fifth waves are harder to forecast. Where they will bottom is 223.6, 238.2, 261.8, 300%. That remains to be seen. That is very hard to nail down. We've done the regular, as I said, 161.8, 76.4. Then it's logical to assume a 5-1 relationship, but the market decided that is not logical, and we continue lower, which is shown here for the S&P 500. We did dip a little bit below the ideal 161.8% extension for wave 3. We rallied to 176.4, which is quite strong. Normally, once we reach the 161.8, the 100% will do. We extend it, and then if you do a typical 5-1 relationship, this is all the things we can only anticipate. That's all we know, right? That's all we know, and then once more price data fills in, we can adjust our targets. We cannot have an exact knowing what's going to happen. However, once we overlapped here in February, remember, we knew then that we had to look for a bounce, for a wave 2 into the target zone, and then we laid out the ideal path the market should take. We had one screw up, so to say, or one curveball, I think is a better name, where we got this 4-5-4 setup, so 4-5-4 setup, And then we were looking ideally lower for a 5S1. That's what you start off with. The 5S1 was already extended to the 200% on Monday, and then we gyrated yesterday, and we're moving lower now. The ideal target is 39.25. As I said yesterday, I have a hard time seeing this going all the way to 3,700. It is possible if we get a very extended fifth wave. So again, there's been no reversals. We need to break above the key levels, as I outlined here for the Dow Jones as well. Same for the S&P 500. We need to see these breakouts. Until then, there is still no signs of a further down. So this is level 1, right, for the bears, warning level 1 in red. Then we need to break, I would say, probably warning level number 2 all the way here. I'm going to do an intermediate one. That's why I'm going to do it in orange, because that's also for the bulls. And then ultimately, of course, the same here. There, that's the all clear sign in my humble opinion, because then we start making higher highs. What will already be a further problem for the bears right here, okay? That would be a break above this bounce high as well, because then we also start to make higher highs, and the levels are right there. For now, there is no signs whatsoever. As I said on Tuesday, we need to break above the high of that day, and we haven't. We got close, but close is no cigar. And I'm sure this is by now the most hated, most not liked market, the most forget it, we're never ever going to rally ever again setup you'll ever see in the market. But so far the bears are right, and those that have negative sentiment are right. We're going lower, so price is still in a downtrend. Here is the bullish cutoff I showed you ways ago. That was breached, and then we knew we had to look for the upside, downside, etc. So we're now extending, and I think we're wrapping up these smaller fourth and fifth waves. Those are always very tricky, just like last Wednesday. Which is wave 3 and which is wave 4 of 3. The market can be quite tricky in that type of environment. So this one needs to be moved a little bit higher. Here is the ideal wave 5 of 5 of 5 of C of 4 target zone. Again, it doesn't have to be ideal. I think we got a wave 3 that's a little bit longer than wave 1. And it starts to look like we're completing another impulse to the downside. Loud and clear, we can now start to see this was the bullish cutoff level. Again, on a smaller time frame. First sign is now break above this level, okay? This is on the shorter term. This is not the daily chart, this is on the shorter term. The next level to watch is, of course, here for the bears. All right, so far the bears are in control. And then the same deal here. I would say this is the next level the bears really want to keep, because otherwise we cannot have any subdivisions on our hand. And this is now, I would say, the bearish cutoff. I'm going to do it in green, call it the bearish cutoff. Everything below it are high risk, cutoff levels for the long side. Okay, market reserves the right to still subdivide lower. Remember, there is no risk in the markets. If you want no risk in your life or in the market, you should ideally be dead, because then there's no risk whatsoever anymore. The only certainty we have in life is death and taxes. So we have to be aware that if we want to try to capture as much upside as possible, we also have to deal with as much risk as possible. So always place your stops accordingly. Never ever trade without any stops. And if you have difficulties with it, please sign up for my major market trading alerts. It will teach you when to go long, how to place stops, when to exit, those type of things. It will teach you to become a very disciplined trader which is key. Just execute. It's really for boring, I would almost say stupid people, in the sense of don't think, just execute. That's what I mean with stupid. Don't think, just execute. So here are the levels to watch that need to break to the upside to start to suggest the low is in place. How are we doing on, excuse me, the futures market? Again, all the target zones have been reached, okay? And now we're simply biding our time to see if we are completing wave 5 of 5 of C of 4. Again, it can always subdivide lower. The market doesn't owe us anything. It doesn't have to bottom at the 200%. But you can see how it really held on to that level for several occasions and then broke below it. Okay, so if one even was desiring to go long here, then of course you place your stop at the same time. And we got strong reactions from it. As far as I can see, this looks like a complex wave 4, something like an A, a B, and a C, or whatever it is. This looks all complex. What I like is we've reached the target zones, all these target zones, and then you kind of go, okay, my work is done. The market has been clear enough. We had a little bit, of course, here of this whipsaw. But as I said, for this, we have to move above this high, which is at 43.03. And all we got was I believe, 43.02. So we did not break above it. The bulls fumbled. This was the Federal Reserve Wednesday high. And since then, we've been impulsing lower with, again, now kind of sideways mess pattern. This looks corrective. And it looks like, again, we're impulsing lower. Next levels to watch are in the high 3800s. I know it seems like, oh, you keep on shifting the goalpost lower. No, I simply anticipate, monitor, and adjust. I anticipated a bottom here, a top here, and a bottom here, and that's what we got. And now we simply have to monitor again. I don't have all the answers. Nobody has. So we simply have to monitor again what's going to happen. And you can clearly see, of course, the cutoff levels for the bears that they need to hold. Same for the bulls. Above 40.64, I would say, is really critical. This level here. This is going to be a very critical level for the bears to hold. Let me put that there in blue, maybe a little thicker, right there, right? So of course now the cutoff level, okay? That's of course for the futures market. So what are others seeing? Gilbert sent an update, publicly available for everybody. He's looking here as well for potential wave 5 lower into the 39.20s, 39.30s. Okay, I agree with it. Looks so far good. Same for Zachary Manis, is also looking for the 39.20s. It's very possible we get a very extended fifth wave. Again, you can see here this mess, which is always hard to interpret from an Elliott Wave perspective. Looks corrective indeed, an A, a B, and a C. So we should still look lower. If we get the lower low and then the breakout higher above these key levels, I think we have a very good sign that we are starting to bottom. But I have no signs of that being in place. Let's look at some market breadth readings. This is the bullish percent index for the NASDAQ100. Okay, we're not even going to look at the price. If I just take the price away, okay, just look at the bullish percent index. I have data going back to 1995. How low are we? Extremely low. This is the 2020, 18, 16, 2011, 2009. This is still data for today, so we're getting at extreme readings we've not seen in a long, long time, from where we, of course, have had multi-month to multi-year to decadal rallies. So we're getting really washed out, but there's no signs of a reversal yet, but it's getting extreme. I don't have today's reading yet. So this is getting extreme. How are we doing for the bullish percent index for the S&P 500? By the way, what is the bullish percent index? It measures how many charts in the S&P 500 are on a buy signal based on the point and figure chart. Look up what the point and figure chart is, and then you know that it's based on those X's and zeros. And also here for the S&P 500, this is today's data, we're at 26. Getting very close to washout lows, going back here to 2010. But it's the same, of course, pretty much as for the NASDAQ, where we were at very relevant lows when we get below 30. even below 25. Okay, so we're getting closer to washout lows, but there's no sign of a reversal. It needs to move back above 30. That's the same here. It needs to move back above 30. We haven't gotten that yet. Meanwhile, the new lows, the 52 new weekly new lows, are still way too high. They did drop today, but one day doesn't make a summer. We have not even reached these washout levels as we had in March. Doesn't have to. The readings have been extremely high for all year, and it's trending higher. So the negative divergence that was in place has been erased. Divergence is a condition. It's not a signal. You need to eventually see price follow up. That we have a drop in new lows is encouraging, but again, it doesn't tell us yet too much other than the new lows are way too high. So suggests further downside. How we're doing in the put-call ratio starts to look a little bottoming here, but no signs of a strong reversal whatsoever. So also this one looks for further lower prices. How we're doing on the PMO buy all indicator, it is really setting up as we were here in December, but actually much more like we were in September last year, or actually 2020, not even last year, and March 2020. It has completely bottomed out. One, it also suggests a weak market. Two, it suggests that once we bottom, the rip will be most likely tremendous, just like we were here. But as you can see here, it can bottom out for a long time. But the longer the bottom is out at zero, the bigger the rally will be. And so far, every single day that goes by, the bigger the rally will be. But we'll take it day by day. Let's have a look at some other BREF indicators. This is how many stocks in the S&P 500 are above their 50-day simple moving average. Data from yesterday. I don't have data for today yet. I hoped it would update, but it doesn't. It takes a little longer. I'm sure it's going to be lower. It's below 20. Now, there's many occasions where it's below 20, but many of those occasions go inside with important lows. I can do all the lines, but every single time you go below 20, odds start to favor. We're getting much closer to at least a tradable bounce, even in a bear market. Assuming we have started a bear market, even in the bear market, we'll need to see a multi-month bounce. And every single time that happens from these extreme oversold readings. But we have no sign of a reversal yet. That will be a move back above, in my humble opinion, 40. How are we doing with the number or percent of stocks above their 200-day moving average? Again, unfortunately, I don't have data yet for today. Excuse me. This goes back to 2001. So we kind of capture one bear market, two bear markets, and a few very severe corrections. And we need to drop below 20, where we can start to say if this percentage of stocks above their 200-day moving average drops below 20, we're starting to get close to important bottoms, except here, of course, for the 2009 crash, where it stayed lower for quite a while. And we also would like to see some positive divergence developing. But most of them, even here in 2008, suggest we should be able to get close to a bounce. It's all about, we weren't here this low at the previous low and when we had the bounce into March. So we're getting extremely oversold, so to say, but there's no sign of a reversal. Now then you can look at this ratio. This ratio, I think, is an even better indicator, and I really want to see it drop below 0.5. If it drops below 0.5, then we start to get close to where we can get really tradable bottoms. That hasn't happened. This whole correction has stayed above 0.5. I think this is an even better indicator for where it should drop to start to look for lows. I don't have today's data yet, but if it drops below 0.5 in the next few days, then we have to start looking for, okay, we might at least get a serious bounce or very tradable lows. I don't have any data for today yet, so that's going to be the cutoff to monitor. How are we doing here? This is a simple, let's see here, 10-day moving average of the percent of stocks in the NASDAQ100 above the 50-day moving average. The current reading is 10, only 10%, so 90 out of the 100 stocks in the NASDAQ100 are above their 50-day moving average. So the 10-day simple moving average is starting to catch up to very low levels, which is 10. And every single time that I have data available. We drop below 10, we're getting very close to important lows. So also there it starts to look like we're racing towards a low. How we're doing on the actual 200-day moving average for the NASDAQ 100. It's at minus 15. Only 15%, so 85 stocks out of the 100 in the NASDAQ 100 are above the 200-day moving average. Data available since 2001. Pretty much every time we drop below 15, we're getting very close, except this one was probably 16 or 17. But again, you can see very arguably, we're getting very close to a low, according to this indicator. But price needs to be rallying above those levels, as I said. These ones just show we're getting really, really, really washed out. There seems to be less left to the downside, even here in 2008. If you compare where we were in 2008 here to what you got then, right? The risk versus the reward from all time perspectives, even here in 2011, 2016, 2018, 2020. It doesn't necessarily mean the absolute low is in, but always think about the risk reward. Again, we then need to monitor price and see breakouts happen above these key price levels. And that is all I have for today. So we are dealing with a unfortunately extended fifth wave. I really would have liked to see price bottom in the ideal wave 5 target zone, but it doesn't have to be ideal. It's been ideal for the second, the third, and the fourth wave. So then most of the time you get the curveball with the fifth wave as well. But as I said, it looks like things are getting very extended to the downside on a lot of market breadth indicators. Hopefully we get some updated data I can send with today's video along with the email. If not, I'll probably attach it to tomorrow's email or revisit it on Friday. So thank you so much for listening. Let's sit on our hands, track and monitor. Have no signs of a bottom being in place other than that we're most likely dealing with a extended fifth wave to the downside. Thank you so much for listening. Take care, trade safe, and I see you all on Friday.